Good afternoon, welcome. You're watching NDTV Profit. This is Market IQ and I'm joined by the veteran investor. I have the absolute pleasure of having him right here with me. We have Mr. Manishi Raychaudhuri to talk to us about, of course, Asia, global. So many things to talk about, Manishi.
Thank you.
So let me start off, first off, with Asia. 2-3 trends playing out. One is there's been a large underperformance in China, which seems to be reversing in some form.
Right.
Japan has done extremely well.
That's right.
India, in comparison, year to date, not as impressive.
Absolutely.
Talk us through your views on what's happening and whether this underperformance in India will continue.
Perfect. Thank you. First of all, it's a pleasure to be here. Thanks to you, thanks to our viewers here. As you rightly pointed out, all throughout last, more than 2 years actually, North Asia, particularly China, underperformed significantly. And that underperformance was even more visible, even more, sort of stark in the context of outperformance by India. In fact, there's a chart I have hidden somewhere. If you plot MSCI India and MSCI China, both in US dollar terms, for 20 years, right from 2001 to early 2021, they actually moved in lockstep. From early 21, the performances diverged. India skyrocketed, China went down. And I think that is, in a small way, reversing now. There are a couple of reasons behind it. First, India to start with, if I look at the beginning of 2024, India was expensive, no doubt, in comparison to its own valuation history, in comparison to the rest of Asia.
Sure.
In contrast, some of the North Asian markets, particularly onshore China and Hong Kong, they were trading at significantly less than their long-term average multiples. In fact, Hong Kong was, if you look at HSI, it was about 8 to 8.2 times price earnings multiple. Compare that to its 20-year average of a little more than 10 times. And there were stocks within the, onshore China or Hong Kong, which were trading at ridiculous valuations. Not only low single-digit P multiples, but dividend yields of in the range of 6 to 9%, which were no doubt mouth-watering to investors.
Sure.
At the same time, we had a few uncertainties in India, and possibly the most talked about is the one relating to elections, election outcome. I think as far as if I go by the popular opinion at this point of time, there seems no doubt that the existing government would come back to power, so there's a policy and political continuity that we can expect. But, in the context of India, one never knows.
Sure.
Right. And these data points about, I would say the turnouts in different phases of polls, that also helped fuel some degree of uncertainty in India, which led to how the FIIs reacted. The FIIs have sold more than 6 to I think about almost $7 billion in the past couple of months in India. In contrast, when you look at the northbound Stock Connect data, they have been heavy buyers of onshore China, and even going by anecdotal evidence in Hong Kong as well. So this is really what's been happening in these markets. And I think the valuation gap has clearly corrected somewhat, but it's still not to the extent of where it should be. If I look at India's valuation premium compared to Asia ex Japan, the long-term average is about 30 to 40%. At peak, at the beginning of this year, it was about 80 to 90%.
Right.
It has come down, no doubt, but it's still in the range of 50 to 60%. So one could argue that there's some degree of valuation correction yet to happen.
Sure. Okay, I'll take a cue from where from where we've stopped at the moment. So, where do you believe the gap is actually getting extended? It's because India's growth story looks too perfect in the eyes of investors? Because clearly we are seeing FII money come out of India.
Right.
So is it largely that India is pricing in growth and China is the more pessimistic of the two? I'll come to Japan maybe in the question after this.
Okay. I don't think there's a degree of pessimism about the long-term growth prospects of India. So everyone understands that this is an economy which has a strong demographic tailwind, which has other macroeconomic tailwinds in the form of the China plus one reshoring of the, of the supply chains that we're talking about right now. So, I think the growth story is well appreciated.
Sure.
But what valuations the investors are paying for that growth, that was, being questioned.
Understood.
It was being questioned more in the context of small caps and mid caps. But even some of the large caps, barring some of the private sector banks, were not really leaving any room for error on the part of the investors. So that was India from the FIIs perspective.
Got it.
And in context of China, it was exactly the opposite. I mean, the things were beaten down to such an extent that it was quite clear that the market was being just too pessimistic about China. Now, there are, of course, and when you sort of peel the onion and go down, there are, of course, what should I say? There are different opinions that come out from different investors. So, for example, if you look at the return on equity for India, that has actually been monotonically increasing. If you look at 2 or 3 years forecast, it is going to increase further from around 16% to about 17 to 18%. It will be significantly higher than cost of equity. It has been and it will be. On the other hand, if one looks at China, return on equity has been in the range of 10 to 10.5, at most 11 for the past 7 to 8 years. Forecasts are not too different. So there is a degree of justifiability for those low valuations, and this is also well understood among the the foreign investors. So, I mean, while we are in the process of this valuation correction happening, will it go all the way to India coming somewhere close to China, China going close to India? I don't think so. India will, and it has always been, and it will continue to trade at a premium compared to Asia ex-Japan, because growth is stronger, return on equity is higher than cost of equity secularly, and the gap will possibly increase going forward. There are other macroeconomic tailwinds. But it is a case of excessive valuation correcting, and that's what we are seeing right now.
And do you expect that to continue?
I would say that much of this correction has already happened. So that valuation premium has come down.
From 80 to 40.
80 to somewhere around, I would say about 40 to 50. Might come down another 10% or so.
Okay.
With India continuing to trade in this range that we have, say it's been trading at a very narrow range. Sensex between 72 to 75,000, that's just a 4% range for the past 6 months.
Sure.
Right. So if this continues, maybe for another quarter, that itself will bring down the PE valuation by somewhere around 4 to 5%.
Yes.
Just think of the quarterly earnings growth and the prices remaining same.
Sure. Yeah, that makes a lot of sense. Okay, so that re-rating happening, at least as we speak. Let me shift focus more towards global. You have US bond yields, which have come off a wee bit, but nonetheless are close to their highs. I can call it that way.
Right.
And we also have equity markets, Indian as well as global, which are very close to all-time highs, ex-China.
Right.
What's playing out, and how much of the rate cut has been priced in, and when do you believe that there will be a window of opportunity for investors to bite the apple before the rate cut happens?
Yeah. Now, this is possibly the most difficult question to answer. Go back 6 months, end of 23, early 24. All the consensus estimates, they were indicating 6 rate cuts throughout 2024.
Sure.
Now we are reduced to possibly 1 at most.
Yes.
And whether it'll happen this year in September, that itself is under question. Is it going to happen in 24 or in early 25? If it doesn't happen by September, then we're too close to the US elections.
Sure.
Would the Fed cut the rates in November or December? That seems a bit unlikely to me. So if it doesn't happen by September, then we possibly have to sort of brace ourselves for no rate cuts in 24 and look at 25 instead. I think a sustainable outperformance by emerging markets and I'm talking about the entire Asia and the entire emerging market complex, including every market here, that would begin only after we have a reasonably certain narrative about the rate trajectory. That, okay, we have now reached the peak. We have had a period of stronger or higher for longer. That's about 1.5 years. And now we are going to have the rate cuts. I mean, that certainty has to seep into the market's consciousness. If that doesn't happen, we're going to be pretty much where we are, which is, kind of 3 steps forward and then again 2 steps back. That continuous change in narrative as far as the US monetary policy action is concerned. I wouldn't hazard a guess, but if I were to give a very off-the-cuff kind of opinion, I'm not really very hopeful of a rate cut this year.
Sure.
I think the Fed would continue to watch the data. There are still reasonably strong employment numbers coming out, because I think not just core CPI, but also the non-farm payroll and other employment numbers are being watched very closely. And I think the Fed would not like to jump the gun. They would clearly want these numbers come down to manageable levels, close to their targets, before making that decision. And I don't really see that happening in the next 6 months.
Sure. And do you therefore feel that markets have scope from here to go higher in case of a rate cut, whenever that may be? It may be 2025. And so that's the first part of my question. The second part is, what would the trigger be? In the past, it's been commentary.
Right.
Would it be inflation coming substantially off and while the commentary remains the same? Or would it actually be a rate cut and the market will wait for a cut before it goes higher?
Well, the market tends to look ahead, right? So, I mean, even before the actual rate cut event, some kind of an eventuality would possibly be factored into the market's valuation. So we will have to watch 2 data points very closely. We will have to watch core CPI, and there are various other, like trimmed mean or, CPIs, etc., which various different economists have worked out.
Sure.
All these inflation-related data points. We will also have to watch the employment-related numbers, not just non-farm payroll or the unemployment numbers. There are various others like JOLTS, which are regularly, communicated to the market. But, it's something the market has to be clear that CPI, core CPI, is likely now to come down to the Fed's target of 2%. As and when that consciousness seeps into the market, that is when, I think we will have a more sustainable rally in the market. Before that, we will have these tactical opportunities. Something trading at ridiculously cheap valuation goes up to usual normal valuations. Something that's too expensive comes down a bit. And possibly, in the second half of this year, it's these tactical games that we will have to continue to play.
Very interesting inflection point that we're at. We have elections, multiple elections across multiple countries, so multiple variables to track. But outside of that, I'll take a cue from the question just before the break. Do you therefore believe that a rate cut, India as well as global, would lead to a rally in the Indian market? And therefore, what should an Indian investor do in that context?
India is right now going through what's called a time correction. The market stays flat, trades in a very narrow range. Earnings growth is still in mid-teens over the years. So over past maybe 6 months or so, the Indian valuation has actually corrected almost about 8 to 10%. I remember it was a little more than 20 times, 20.5 or so on Nifty, 1 year forward P multiple. It's, I think, around 19.3 to 19.5.
Sure.
So this might continue for some more time, till the uncertainties, both domestic and global, are resolved. After that, what are we looking at in the context of India? Would there be a significant re-rating from these levels? That seems unlikely to me. I would rather hang my hat on earnings growth driven performance of the market, which is the mid-teens kind of return throughout the year. And that is, it's pretty decent from the perspective of a long-term investor. I mean, if he gets around 15 to 17% CAGR over a long period of time.
Sure. Okay. I take your point there. And just with regard to where the pockets of opportunity within India currently are at.
Right.
You've spoken about large private banks.
Right.
What puzzles me is the re-rating there does not seem to happen. Of course, various reasons.
Right.
I believe the investor community not able to identify where the asset quality challenges could come up
Right.
in the next cycle.
Right.
Could be one of the reasons. But your sense with regard to that particular pocket and why that re-rating has not played out
Right.
yet.
You know, you rightly point out, and I actually hinted earlier that private sector, particularly frontline large private sector banks, could be an area where investors could make long-term significant returns. In the banking sector, we normally tend to focus on those banks which, number one, have a significantly better than average asset quality. Number two, the banks which are gaining market share. I mean, think of the public sector banks, they still have somewhere around 65 to 70% market share, but the private sector banks are chipping away at that market share regularly. They have much better technological platforms which are enabling them to gain market share. Earlier, the private sector banks used to be at very expensive valuations. I remember some of them trading at 4 times price to book or so. No longer. That's not the case anymore. Those same banks are down to about 2 to 2.5 times price to book. Right, so after this underperformance that some of these private banks have suffered for, I think, almost a year now, you know, it seems been an opportune time for me to sort of focus on these private banks again. And you know, if these drivers that I talked about, better asset quality, gaining market share, you know, one of the earlier drivers may not last, which is expansion of net interest margins.
Yes.
That might have come to an end by now, but the other tailwinds are still quite strong. No, so that's, you know, one of my reasons for focusing on the private sector banks. I mean, I would not be very hopeful of further strong re-rating of these banks from now. But even if they grow in line with their expansion in earnings or price to book, as I said just now, that's pretty decent returns from a long-term investor's perspective.
Understood. So you don't find them extraordinarily cheap, but you believe that earnings will now drive the stock upside.
Absolutely.
Value re-rating, not as much in your view. Okay, I take your point. With regard to maybe some of the other sectors, engineering, cap goods,
Right.
we've seen extraordinary numbers on the back of course, very good infra spend,
Yes.
very good public spend.
Yeah.
What's your sense with regard to private capex, if at all? And what's your sense with regard to now the valuations in a couple of these pockets,
Right.
given that they've inched up by quite a bit?
Right. Now, infrastructure, industrials, engineering, that's a bit of a tricky area. So the growth runway is very strong. You know, because, I mean, I personally believe that if we do have political and policy continuity, then this investments in infrastructure that we have seen, that we're continuing to see, that'll likely continue going forward. And therefore, we're likely to see earnings estimates also moving up in this sector. A stock that looks relatively expensive today might appear relatively cheap tomorrow if the earnings estimates expand.
Yes.
Right? At some point of time, this government capex, infrastructure expenses and otherwise, that would seep through to private sector capex as well. You know, I think it's been happening in a very small way, you know, but not really, it's not quite extensive at this point of time. Ultimately, we have to remember in India, all private capex cycles have been originated by government capex.
Yes.
It's the large government orders which force the private companies to expand their capacity, you know, because they have to supply those government orders. Right, so, you know, I would think that, you know, it would have to start at some point of time. Everyone is now waiting for the election results, therefore looking at the policy and the next full budget sometime in July. I would really be hopeful about the sentiment on private capex improving by the fourth quarter of this year.
Okay, and with regard to defense and railways, again, very similar theme, government spend. But really, in terms of just the way in which assumptions have been made and the way in which stock prices have moved, it seems to be pricing in 5, 6, 7 years of growth. What do you make of valuations at this point? Would you be cautious?
You know, 1 year ago, I think with one of your colleagues, I was, must have been in the same studio. And I was quite aggressively talking about exactly these railways and defense companies. Now, the way these stocks have moved, it does make me a bit cautious about their valuations, unfortunately. I think the fundamental story is great. India will have to invest more in transportation infrastructure, both intra-city and outside the city. India will have to spend more in defense, and there is actually a kind of communicated target from the government to do that. Have the stocks discounted more than maybe even 2 to 3 years earnings runway? I think in most cases, unfortunately, they have.
Okay. And with regard to any other pockets where you feel that there is a bit of caution which is necessary for the investor, we've seen small and mid-cap stocks as well as the index itself rally. It's been a one-way street. Do you feel, therefore, that it's time to be a little cautious there? And any other specific sectors where you're cautious?
I would definitely be more focused on large caps than small and mid caps now. Even though small and mid caps have corrected quite a bit. Among the sectors, I would be cautious about consumer staples.
Okay.
We are seeing rather pedestrian earnings growth over there, while many of the frontliners are trading at about 50 times PE. So those are the two top of the mind recalls as far as having a cautious stance is concerned.
Right, and with regard to pockets where you still find an opportunity at this point where markets have seen a decentish rally. So where should an investor look at now in terms of look for value in this market outside of private sector banks? We spoke about those.
Yes, we did speak about that. I would also highlight the healthcare sector. Because there, both in diagnostics, in generic pharmaceuticals, there is, I think that potential growth is not really being factored in. After all, India is getting more affluent. Apart from buying fashion, retail, and other stuff, that necessarily means increased focus on healthcare, on diagnostics, on athleisure. I think that segment has not been played adequately.
Amazing. That's a great perspective because chemicals also seems a bit ignored in that sense. But it's been a great conversation, Mr. Raychaudhuri. It's of course it's a never-ending conversation, but unfortunately I've been flagged that I need to close this this conversation. But with that, completely out of time on this edition of the show. Thank you so much for coming in, speaking with us.
My pleasure entirely.
And giving our viewers all of that perspective. But it's time to say goodbye from everyone here. Thank you so much for tuning in and watching us. On the other side, we'll continue our live programming. Stay tuned.